very much, Dr.
No problem.
Okay, so hello once again, ladies and gentlemen. We are here to, in case if you haven't heard, as it was announced in the economic data release, today we're going to discuss the ADP non-farm employment change. And I would like to remind you that job creation is an important leading indicator of consumer spending, which accounts for a majority of overall economic activity. And as you can see at the current moment, the forecast for February is 185,000 and the January figure was 175,000. U.S. private sector job market rose by 175,000 jobs in January, according to the national report, and the main contribution to job growth came from the construction industry, which added 25,000 jobs. Manufacturing sector narrowed in January with a 12,000 decline following a revised gain of 60,000 in the previous month. A smaller job gain of 159,000 is anticipated now. As we move further, dear guests, it is possible to see different experts from banks and firms around the world and their estimates. And according to this data, it is possible to witness the median estimate of 155,000, average estimate of 155,000, and high estimate of 180,000, whereas the low estimate is 100,000. And the data was based on 39 surveyed experts on estimates. So, talking about the forecast further on, I would like to quote James Pacherno, analyst from CapitalSpectator.com USA, that the economy has been creating jobs more slowly in recent months, and this deceleration is expected to continue with today's February report on private payrolls based on the ADP's estimates. Another soft update isn't terribly surprising if you subscribe to the view that a rough winter has weighed on growth. In that case, February's storm will have the predictable effect on the labor market. Economists are expecting as much. The consensus forecast calls for private payrolls in February to increase by 150,000 versus the previous month. That's noticeably slower than January's 175,000 advance. If the crowd's expectations are accurate, we'll see the third straight month of slower growth for private payrolls in today's ADP release. In that case, there will be a stronger case for keeping expectations muted for Friday's official jobs report from the government. February's jobs data may be a victim of the weather, but some analysts are wondering if a wobbly labor market will push the U.S. Federal Reserve to rethink its current plan to announce another installment of winding down its bond buying program at its meeting that is scheduled for later this month. Finally, moving on to the fundamental aspects. Yes, here they are. The impact on the U.S. dollar Japanese yen by our community members, and as you can see, most of the members were bullish on the matter. That is 54.55% bullish versus 45.45 bearish votes on the matter. And one of the bullish comments by Agavi that payroll will increase as big corporations are hiring more at the beginning of this year. And one of the bearish comments by Alexari that due to rough winter in the U.S., I'm anticipating fewer hiring than last month, hence bearish on U.S. dollar Japanese yen. So that is it from my side, dear everyone, and at this point I would like to give my word to Alex, who will cover on the technical stuff. So Alex, my word to you.
Thank you, Paulina. Hello, everyone, once again. Hello, Dr. Dell. So today we are discussing the potential impact of the US payrolls on the greenback. And we all know that on Friday we're having another release of the employment data as well as the unemployment rate from the United States. And therefore today's report will be just an insight on what's happening with the labor market. However, I would like to point out that due to the severe weather conditions, the data will most likely surprise markets to the downside. However, that's also getting more obvious that markets are already priced in, so market reaction will be quite muted. And we see that, that's actually the 4-hour chart on the EUR/USD. We see that during the whole February, the pair has been on appreciating. And actually, the pair managed to perform a 350 pips rally, so quite an impressive move during one month. However, after reaching a recent high of 138.25, the pair began moving to the south, and currently it's fluctuating around 137.31. So our negative surprise trading strategy is based on the EUR/USD, as you already guessed, and it includes the entrance point at the market price. As always, that's actually 137.31 once again. The potential take profit, we suggest placing it around weekly pivot and 4-hour resistance around 147.46. That's just 15 pips from the market price. So as already said, we do not expect the pair to be highly volatile. As to the stop loss, we suggest placing it around 4-hour pivot or at the 200-minute simple moving average. And you see that I placed it between those. To be more precise, that's 137.25, and in pips that will be just 6 pips from the market price, so not a very risky trading strategy. Well, speaking about market sentiment, you see that currently it's slightly bearish, with 58% of all open positions being short. Meanwhile, the single currency is bought in 53% of all cases, while greenback is bought almost in 60% of the time. And you see that pending orders is also ready to provide additional support for a bearish movement, as more than 55% of pending orders are placed to sell the pair. Speaking about market sentiments provided by other market participants, we see here a similar situation, as vast majority of traders at Orlando, Saxo Bank and Daily Fix are selling the pair. However, I would like to stress out that compared with Monday, I guess, the market sentiment has changed slightly, and if I recall correctly, that was highly above 70%. So we see that traders are not so sure that the pair will be depreciating in the nearest future. And as always, let's have a look at technical indicators. Well, we'll still have 2 minutes before the news release. So we see that vast majority of them are suggesting that the pair will move sideways. However, indicators on the daily and monthly charts are pointing at pair's appreciation. Therefore, a retest of 138.25 looks rather probable. So, just a couple of seconds before the news release, I guess it's time to switch to the chart. Currently, the pair is still fluctuating around 137.32. And we see that during the last 1 hour, well, the data is already out, so it came worse than expected at 139,000. So the market traction is obviously bullish, with the pair soaring to 137.42, and the initial market reaction is just 10 pips. And as I already said, the markets have already priced in the potential negative effect of the payrolls, therefore market reaction is quite limited. And you see that currently the pair is trying to inch above a recent high around 137.44, and then just 2 pips higher we're having our take profit placed. So once again, due to the fact that data surprise markets to the downside, the pair is expected to appreciate. However, on Friday the pair will be most likely more volatile, as unemployment rate and non-farm payrolls will provide some more information about Fed's future movements. So we see that the pair is appreciating, and it's just have reached our take profit level. So the trading strategy worked very well, and even though the pair has even moved above this level, just 2 pips above it. So, and once again, the initial market reaction is 18 pips during the 3 minutes. So, as we expected, practically. And just to conclude, I would like to show you a table with all sentiments with the United States dollar crosses, and we see that practically in all cases the greenback is expected to appreciate in all cases, but the Austrian greenback. However, if I recall correctly, during the last half a year or so, it has been strongly bullish, so that's not a really quite strong indicator that the pair will appreciate in this particular case. So once again, the data is worse than expected, therefore the euro is expected to appreciate versus the greenback, and our trading strategy worked very well. And one more thing I would like to show you, that's the potential next key level for the long traders, and I suppose that that will be a daily resistance and February 19 high, right at the level of 137.75. So that's around 35 pips from the market price, and I guess for today it's unlikely to be reached as practical data is already out. So I guess that will be all from my side. Hope that was useful for some of you, and back to you, Paulina.
Thank you very much, Alex, for covering on the technical side of the matter. So just a quick reminder, so the forecast for ADP non-farm employment change was 155,000, whereas the actual came out worse than expected, 139,000. So, Doc, I mean, was the case of the bad weather that bad in this situation?
What is real curious is what's really curious is construction jobs were up 14,000 in February. It's kind, you would think that construction is the pretty much an outdoor profession, and the curious part is I guess we've been getting hit. As I've been crying to you about the cold snow. We still have about I'd say about 3 centimeters of snow on the ground, and the Northeast in general has about 70 some odd million between Washington D.C. and basically Boston, and so about a quarter of the population is right here, and we have been getting hit pretty hard. So those construction numbers are probably from outside the Northeast. They're maybe in the warmer areas. The weather has been bad, straight throughout the whole year, and put that on top of everything. They marked down 48,000 off of last month's ADP number. So it's a real confusion there. We're looking at some. I looked at a scale just now since 2011 over the last 3 years. Misses by ADP versus the Bureau of Labor Statistics, the BLS, that's coming out on Friday, and sometimes they have no effect whatsoever, even when they're big misses with ADP. So we still may see a decent number on Friday, but overall, yeah, it's been cold. Like I said, we have about a little less than 3 centimeters of snow still out on the ground. I mean, the pathways are all shoveled, the driveways are all cleared, the sidewalks are all cleared, so forth. But the snow is still there where it's not, where we don't walk and catch buses and do everything else. So overall, I just have to look at the numbers and just say that's just, it's just the bad weather. And one or two bad days of weather in the United States can have a profound effect. Because we are constantly running. As a business, America, as much as what's going on with Mr. Obama and his socialist policies, we still are more dominant in business so in other words, one day disrupts everything. So everything Alex seemed to say makes plenty of sense to me, and at the same time, it has to do with the weather, and you scratch your head when you try to figure out where they found the 12,000 construction jobs to be increased, and they found like accountants and indoor jobs where was the mild loss out of it all. So, which is really odd. I don't know. That might be a lack of business confidence. That's the only way I can interpret it, is a lack of business confidence. In other words, businesses are not trying to grow. And so that would actually be the opposite about the weather. In other words, it's not the weather as much as it's a lack of business growth, confidence. So I don't know. It's kind of mixed. We could say it's the weather. It could be justified as the weather, but at the same time, we had construction increase by 12,000. So got to scratch your head at that and wonder how did they? If the weather is affecting us so strongly, how did it affect us? So see my point there? We shouldn't have gotten that 12,000 increase in construction.
Indeed, yes. Thank you very much, Zagdal, for your comments on the matter. And I guess we will no longer away from your webinar. So let me just find your slides. And
there we go. That's around here. There. Nope, not that one.